Hi there. So in this video, I'd like to talk to you about the balance sheet. Now, this is not an accounting class. This is a finance class. And so the perspective that I'm going to give you is going to be less accounting, which means that I'm not going to go into individual line items on the balance sheet. Rather, I'm going to give you the basic structure of the balance sheet, just go over it, but then also emphasize the points that you should bear in mind as a financial manager when you're looking at a balance sheet. So here's a typical balance sheet structure. On the left-hand side, you have assets, and assets are divided into two types. You have current assets and fixed assets. The way you want to think about this is that current assets are basically those assets that are going to result in some cash coming into the business in less than a year. So these are your short-term investments. And then you have your fixed assets. These are your long-term investments, which means that these are assets that are going to give you cash inflow over a course of more than 1 year. So it includes all this good stuff like property, plant, and equipment, and intangible assets like patents and goodwill and all that. On the right-hand side of the balance sheet, you have your sources of funding. Specifically, you have liabilities, which are again divided into current liabilities and long-term liabilities, and then you have your shareholders' equity. Again, the way you want to think about the balance sheet as a financial manager is that on the left-hand side, you have your uses of cash. This is all where the money has went, where all the money has went. The right-hand side of the balance sheet, the liabilities and the equity, this is all where the money came from. So some of the funding was provided by short-term creditors, some by long-term creditors, and some was your own money. So you had preferred stock, common stock, all this is different forms of equity. Again, very deliberately, I'm not going into the individual line items. We could spend a whole lecture on that. But this is the basic structure of a balance sheet. The balance sheet balances because the uses of cash, which is assets, equals to the sources of cash, which is liabilities and equity. So the balance sheet balances, and you're like, okay, yeah, tell me something else. Well, here's one thing that you must bear in mind when you're looking at a balance sheet. Again, this is something that you've heard before, but you really need to appreciate the essence of what this is saying. Balance sheet is a snapshot of a firm at a particular point in time. What that means is that when you're looking at a balance sheet and you see, for example, accounts receivable of 270 million, what that means is that accounts receivable was 270 million at the end of 2019, and that is it. My point is that you don't get to tell anything by looking at this number, what accounts receivable looked like during the entire year, how it moved. All this says is that accounts receivable is $270 million at the end of 2019. This is literally like, let's suppose that you were a student, you just graduated, and right about October, you get your first interview, and then in November you get the hire, and then by the end of December you get your bonus and you're hired. But before October you were actively looking for jobs, you had no money whatsoever. If somebody looks at your December end bank statement and says, hey, a bonus of 50,000, you're doing great. You're like, dude, I was living off of ramen noodles for practically half the year, if not more, right? By looking at this December end stuff, you don't get to sort of see what happened during the year, and that's my point. When you're looking at a balance sheet, the balance sheet by itself doesn't really tell you how accounts receivable changed during the year. It's just a snapshot at a particular point in time. This is very important for you to bear in mind. Later on, when we'll do some ratios to assess the financial health of a company, this point is going to be particularly important to bear in mind. Okay, so that's point number one. Point number two. On the asset side, assets are listed in the order of liquidity. Now, you've probably heard the term liquidity before. If I ask you what is liquidity, your go-to answer is going to be, it's the ease with which an asset can be converted into cash. Yeah? Okay, great. Let me ask you a question. Let's suppose that you have a house, right? And its market value is $500,000. And it's got 5 bedrooms, it's got a pool, it's got a yard, the works. You go on Craigslist and you list your house for $50,000. How soon do you think you're going to be able to convert it into cash? I'd say pretty quickly. Within 2 minutes, someone's going to give you a call. I have the cash ready. I'm coming. Keep the paperwork ready. I'm here. I'm just coming to get the house, right? You'll be able to sell that house pretty quickly. Isn't that right? Does that mean that your house is liquid? Is it a liquid asset? It's a $500,000 house that you're selling for $50,000. You're able to convert that asset into cash rather quickly, but is it liquid? No, no. Being able to convert an asset into cash is part of the answer. You also have to say without a significant loss of value. Without a significant loss of value. Now you might say, well, what do you mean significant? Well, here we mean, a value. The asset needs to sell at a value which is very close to its market value. If it's a $500,000 house, right? If you can sell it very quickly at or about $500,000, that would make it liquid. But if the price is right, you can literally sell anything very quickly, right? It's not just about that. It's about how quickly you can do it without losing a lot, right? So bear that in mind about liquidity. So as you can see, cash and cash equivalents by that very nature is the most liquid because they're actually cash, account receivable, inventory. Again, you can convert into cash rather quickly. And then some of your more long-term assets, these like your house, are going to be harder to convert into cash without a significant loss of value. So that's why these tend to be less liquid. So again, remember that about liquidity. All right, so point number 2. Point number 3. Remember the right-hand side of the balance sheet where we said that these are all your sources of funding. This is liabilities and shareholders' equity. So this is one way of thinking about the right-hand side of the balance sheet, which is its sources of funding. But another related way of thinking about it is that these are claims. These are claims on the cash flow that is going to be produced by the assets of the firm. Let me say that again. These are claims on the cash flow that is going to be produced by the assets of the firm. When financiers like short-term creditors, like long-term creditors, like equity holders, when they provide funding, they're providing funding, but that provision entitles them to some sort of claims. Now, depending on what kind of a financier you are, your rights, your claim will be different. So liabilities, or specifically debt holders, have a very different claim, right? They have a fixed contractual obligation that this is the interest expense that we're going to receive because we're giving you a loan, right? So that's a very specific kind of a claim. They don't get any voting rights, well, not usually. But they can force the firm into bankruptcy if they're not getting their contractually obligated interest payment or principal payment. Shareholders' equity claim is very different. They're at the bottom of the pyramid. They get whatever is left behind. They're called residual claimants. Look, my main point again is this. It's useful to think about these parties as claimants. Why is this useful? It's because later on we're going to talk about the stock market and the bond market, right? These are basically markets in which these claims are being bought and sold. I have a claim. Like I'm an equity holder, I'm a stockholder in a company, I have a claim on that cash flow, right? Residual claimant. I don't like it, I can go sell my claim to someone else, right? These are claims that are being sold, right? So the reason why it's useful to think about these claims is because if claims are in terms of cash flows, then the price that you're going to be able to attract outside in the market for these claims is going to be a function of, well, these claims, right? What these cash flows are. So it's useful to think about the right-hand side as claims. All right, so that's the second last point. The very, very, very last point, and this is perhaps the most important one, often overlooked by a lot of people, is that the balance sheet shows book values, not market values. Everything that you see, well, most of the stuff that you see on the balance sheet, there are some qualifications here, but most of the assets, most of the liabilities, most of the equity that you see on the balance sheet, these are book values. Also, sometimes we also use the term, we see stuff at historical cost. What does that mean? Look, accounting is basically very, and I don't mean that as derogatory to accountants in any way. It's just the nature of the profession. It's somewhat backward looking, right? It's historical in perspective. It just says, 1 year ago you bought stuff at $100,000. Now it has depreciated, for example. Now it's worth on the books as $80,000. It depreciated by $20,000. Okay, that's a very historical perspective. That's bookkeeping. But if you have an asset which you bought for 100,000 and it depreciated and now it's worth less in the books, that does not mean that its value is necessarily lower in the market. Let me give you an example. Let's suppose that you went ahead and bought a painting for $100,000. So you bought an asset which was worth $100,000. So you'll go on the left-hand side of the balance sheet and you'll say, hey, I have an asset. It's a painting. I bought it for $100,000. And the way I bought this was that I used a loan of $40,000. I went to a bank and bought the painting. And the equity that I put in was $60,000. So that was my money. So the balance sheet balances, right? 100,000. And I have 100,000 here. The asset equals to liabilities and equity. Okay. Now, a year later, let's suppose that the person who painted this painting passes away. As it usually happens when the artists die, their paintings actually become, well, more valuable. So let's suppose that this painting now becomes worth $300,000 for some reason. On the books, it's still worth $100,000, assuming it hasn't really depreciated in any way. On the books, it's still worth $100,000, but now in the market, you can fetch $300,000 for it. Okay. Your loan obligation to the bank or whomsoever you borrowed the money from, you still owe them $40,000. Again, let's suppose you haven't made any interest payments or principal payments, which means that if you went and sold the painting for $300,000, and if you paid off the $40,000, this means that you'd be able to pocket in $260,000. So the market value of your equity is $260,000. Right? The balance sheet also balances this way in terms of market value. In terms of market value, your balance sheet is balancing as well. But my point is that you don't get to see any of this. You don't get to see this on a typical balance sheet. All you see on the balance sheet is this stuff, book values. Which do you think you're more interested in? Book values or market values? Please say market values, okay? Market values are important because it is what the market is able to offer you for your assets. That is what you care about, right? If you buy a house for $300,000 and 3 years later it's worth $1 million, do you really care how much you paid for it? No, you care about what it's worth today. That is what influences the worth of your asset. That is what influences the value of your equity. That is what is going to influence your ability to get a new loan, right? To finance maybe other investments. As a financial manager, you always care about market values, not book values, which is why we're taking less of an accounting perspective and more of a finance perspective here. So these are the things that I urge you as a financial manager, always keep in mind when you're looking at a balance sheet.